Hello class, this is Brian from FinancialTradingSchool.com and welcome to GT307 Inflation. So just a couple notes before starting. My goal for this lesson is to help you understand what inflation is so that you can be aware of it in the economy. But just like GT306, creation of money, I plan to keep it simple. I don't want to get into the details of proving any theories or mechanics behind inflation. Just simple inflation, what it is, how it works, and the things to be aware of. Furthermore, inflation is a long-term concept, so this affects the big picture, meaning it can't really be traded in the short term in the markets, but it does affect trading mentality over a period of time via expectations. For example, if inflation is expected to rise in the US, then people will expect the US dollar to devalue or weaken over time, and then you trade that accordingly. And vice versa if inflation is expected to drop. So that's it for this introduction. Let's get started on the lesson. Let's start off with a basic definition of inflation. Inflation is the rate at which general level of prices for goods and services is rising and subsequently purchasing power is falling. Central banks attempt to stop severe inflation along with severe deflation in an attempt to keep excessive growth of prices to a minimum. So that's the technical definition of inflation. Basically, inflation is just where prices go up and the amount of goods that you can buy with your dollars is going down. That's it. So I'm going to start off with two basic scenarios. The first one is the base, and the second one will have inflation. And in order for this to work, we must be in a perfect world. A perfect world is where people are rational and everything else is kept constant. People are rational means they behave to benefit themselves. So if given a choice, you want more money than to have less money. You want to be well fed than to be not fed. You want to survive rather than to die, etc. So in the first scenario, what we're going to have is we are going to start off with, say, 10 people in one room, and there are going to be 10 apples in the room, and each person will have $1 each. And basically what's going to happen is people are going to bid up to whatever they think the apple is worth. And in this world, they must eat an apple to survive for the day, let's say. So an apple will keep them living for that day, and they only have $1 each. There's 10 people, 10 apples. Just by basic logic, you can probably come to the conclusion that each person will bid up to $1 because they each have $1 to bid up, and they will just put all their money into it because if they don't eat, they're going to die that day anyways. So ultimately what happens is the price of each apple will be $1 each. In scenario number 2, what we're going to have is we're going to have the same 10 people, we're going to have the same 10 apples, but instead of $1 each, they now have $2 each. So at $2 each, the same mentality holds. They must eat the apple to survive for that day. And they know that if they don't eat, then they will die. So they're all rational, so they all bid up to the max that they can bid, which is $2. So the apple is priced at $2. And the difference between the two scenarios is just one day in time, but they had more money in the second scenario. So they bid up to the max, which is $2. So if you think about the actual inflation rate is 100% because the price has doubled. So that's inflation. Now, what I want to get into is a thought process of why this happened. There are basically two explanations to explain why inflation happened. The first one should be pretty obvious. The second one probably not so much. So let's deal with the obvious one first. If you compare scenario number 1 and scenario number 2, the first thing that stands out right away is that you have more money. So let's explain that. So that's the first one. First one is money. You have more money. What happens when you have more money? The first scenario, there's a total of $10 in the room, 10 apples in the room, divide each one, 10 divided by 10, you get $1. The second scenario, you have $20 in the room, but only 10 apples. You have more money, same amount of goods. You have more money, that means your money's worth less than it was before. So since it's worth less, you're willing to offer more for the same amount of goods as before. So $20 divided by 10 apples is $2 each. So since you know it's worth less than before, you're willing to offer more for the same amount, which is the same one apple as before, because you still only need to eat one apple to survive for that day. So that's the first explanation, and that's pretty straightforward. The second one, probably not so much. The second one looks at the number of apples and the perceived value of the apples. So I just draw an apple with a circle in a little stem like that and a leaf. So that's an apple. Basically, the title for this is limited resources. So looking back at the first scenario, you had 10 apples, $10. By the end of the day, everybody paid $1. So by the end of that day, you go to sleep thinking, okay, so I paid $1 per apple. That's your perceived value going into the next day. So day 2 starts, and they tell you 10 people, same room, and they give you $2 each. So in your mind, you're thinking, okay, so last night I paid $1 for each apple. They're giving me $2 now. So I'm expecting to see 2 apples in the room for me and for each person. So 10 people times 2 is 20 apples. But instead of 20 apples, they only give you 10 apples. So that's limited resources. So basically what this is a shortage of apples. You're expecting 20, you get 10. So since there's a shortage, you bid up the price. And that's why the prices of apples went from $1 to $2. So these 2 explanations are the 2 basic premises of what inflation is and how it happens. So why does this matter? If you'll recall in GT306, Creation of Money, towards the end of the lesson, I left you with a thought of the central banks of the G7 countries have been printing a considerable amount of money throughout the past 5 years. Ever since the financial crisis, they've been printing a lot of money. So if you were to Google the money supply chart for the US economy for the past century, it would look something like this. You have money supply on the vertical axis and you have time along the horizontal axis. It starts at 1900, goes all the way to 2008, and then this is the financial crisis, and then this is the current year, 2013. So basically what it looks like, essentially, it's not smooth like this, but essentially what you have is a flat line like this. This is basically what happens between 1900 and 2008, and I think this level here is about $900 billion. So they printed about $900 billion throughout a century, something like that. And then for those of you that have been paying attention to the news throughout the past 5 years, you'll know that they've been printing quite a lot of money within the past 5 years compared to the last century. So let's just talk about the last century first. Typically speaking, what central banks aim for is a 2 to 3% inflation rate on a year-to-year basis. And basically this inflation rate is derived from how much they manipulate interest rates and money supply. And for the most part, a 2 to 3% inflation rate on a year-to-year basis is not a big deal. Because if you look at, say, a $100 item, plus 2% is only $2 extra. Even if you look at a house, a $200,000 house, plus 2% is only $4,000 extra. So it's not a big deal. And that's basically the point that I'm getting at. On a year-to-year basis, 2 to 3% inflation rate is not a big deal. But what is a big deal is if you have a drastic increase in inflation. So now let's look at 2008. What happened in 2008? Financial crisis, housing market crash, they printed a lot of money. On a money supply graph, what this basically amounts to is this. You go from printing $900 billion over the course of 1900 to 2008. In 108 years, they only printed $900 billion. Then within the span of the last 5 years, they printed this much money. The first spike was, I think, about 700 billion. So this little height here, they did something like this, and then they did something flatter like this throughout the last 5 years, something like that. So that's essentially what happened over the past 5 years. They've been printing that much more money within 5 years compared to the last century. So let's just let that sink in for a minute. This whole area between here to here is only 2 to 3% inflation rate. If that's 2 to 3%, what do you think this part represents? I know a lot of you look to me for answers, but I don't have one for you right now. I don't know what the inflation rate will be based on how much money has been printed in the past 5 years. But I do know what it's called. It's called hyperinflation. Hyperinflation is basically inflation on steroids. So you can use your imagination to figure out what the inflation rate could be. And for those of you that have already figured it out and are questioning whether or not this can happen, well, I can tell you that it has already happened. 2 instances in history that it happened. Zimbabwe and Germany. Zimbabwe, they printed too much money, and I think you can go on eBay to actually buy their currency. They have billion-dollar bills or trillion-dollar bills, I'm not sure, but they have a lot of zeros in their bills. And then you might be questioning, well, they're not a G7 country. That is true. Okay, fine. So let's talk about Germany. Germany, post-World War I, in the early 1920s, they did the same thing. During World War I, I think they printed too much money, so then after the war was over, hyperinflation kicked in, and basically they were screwed for a number of years, and then they recovered. Being a big country, they recovered. Zimbabwe did not, however. So this is where I want to end the lesson for this week, because we're approaching the 10-minute mark. I just want to warn you ahead of time, hyperinflation is a depressing topic, so don't say I didn't warn you. Next week, what we will be talking about in GT308, hyperinflation, I'll be going over what is hyperinflation, why it hasn't happened yet, and how do we deal with it when it does. So that's it for this lesson. Hope you guys enjoyed this, and I will see you guys next time.